This is a good question in all honesty. Is it a good idea to invest in the stock market when it's at its all-time high? Is this smart or is it stupid? Well, in this video today, I'm sharing with you some facts as we look back on the history to see if we need to hold off on your investments and then go all in when the stock market drops back down. Well, hey, if you like personal finance content just like this video, make sure you subscribe for more awesome content coming soon. Lena says, is it recommended to buy ETFs at an all-time high? What a great question. Now be honest with me for a second. Have you ever had that sense of worry when investing in the stock market that, hey, maybe it's too high and I'm gonna lose my money when it corrects, when it goes back down? So if you've ever felt that way before, trust me, I've been there too. But I found a much less stressful and a better way to invest. So let's dig in and talk about it right now. Is it smart or stupid to buy in at an all-time high? Well, you're not gonna like my answer at all. It's a little bit of both. What? Yeah, both. First, let me dig into why it's stupid. And then what I'll do is we'll talk about why it's smart, and I'll give you some free tips, some free value in this video, so you can start on the right foot in your investment journey today. Here's why it's stupid. We're gonna break down why, and we're gonna break down the facts. First and foremost, if you're investing at a high, because either number one, you hear about something going to the moon, such as AMC, GameStop, Dogecoin, Tesla, or anything like that, chances are, a lot of times that you hear about this hype stock, you've already missed the rocket to the moon, and you're either getting in while it's almost very much at the moon, or it's halfway there and you're having a little bit of struggle and you stress out and you sell because maybe it has a little bit of a correction and it dips back down. So if you're jumping in on the hype stock, that's number one issue. Number two, which is much more logical in my sense, is let's say you have, I don't know, $1,000 or $5,000 and you want to invest, but that's all you have and that's all you invest. What you do is you today put in $1,000 into the stock market and then you just kind of don't do any more investing for a long, long time. That is really dumb because what could happen is your value could drop. Like for today, for example, let's say the stock market's up, you put in $1,000 and next week it goes into a correction. Maybe it drops 5%, maybe it even drops 10%. And all of a sudden you look and then you start panicking because your $1,000 could be worth, I don't know, $900 or less. Yikes. Oftentimes new investors come to me in a panic because they've done one of these two things. And let's say there is a market correction, or even worse, let's say there's a crash, such as the 2009 financial crash or the 2020 pandemic crash. What happens is you invested at the high, it dropped down. These new investors end up getting frustrated, they get annoyed, they get irritated, and the worst part is they end up never investing again. They feel the investment arena is a big scam, it's a lot of work, it requires some help of a professional, and because they got burned, they're never getting back in again. That disappoints me. Now, how I see it is investing should be more than just a one-time date to the dance. It's about building up a mountain of portfolio growth over time. Now that means as you go up the mountain, you're gonna have your ups, you're gonna have your downs. You're gonna have rocky obstacles to get over, and then those times that you feel you're making great progress. You're gonna have sunny days, you're gonna have snowy and rainy days. But regardless, you keep going up the mountain. And that's what we want in our investment portfolio, my friend. But check out this. If you look back on history, if you look back on the facts, the S&P 500 index has grown at an average rate of 13.9% per year from the years 2011 to 2020. Now, I want to send that back even further. Let's go to the last 50 years. If you look at the S&P over the last 50 years, it grew by 10.9% on average, or if you want to adjust for inflation, 6.8%. So if you look long term, your money still ends up growing. And of course, what does this do? This brings us to the smart plan when it comes down to investing at an all-time high. So investing at a high is smart if you do it on a consistent basis. As we talked about earlier, if you invest just one time and it crashes or it corrects, you're gonna lose money in the short term. But let's take a look for a second at March 2020, right before the pandemic hit. If you invested right before that pandemic, right before the quarantine, yes, you would have lost around 34% of your money in that short period. Ouch, that hurts. And any new investor would be freaking the hell out. If you put $1,000 in, you lost 34%, nobody feels good about that. But if you would have just said, that's cool, I'm just gonna hang on to it, assuming you didn't freak out, guess what? Your money today would have grown 19.81% positive. just by holding on through that tough period of time. So let's look as an example at ticker symbol VTI to explain this a little bit more. Now, I talk a lot about VTI on this channel. This is a Vanguard fund that tracks the total stock market index. Around February of 2020, the price of VTI was $171.70 per share. Let's say you bought a share. You bought $171, so you own one share of VTI. Well, then guess what happened right after that? Market crashes, market dips, and now it fell to only $115.19 per share. You lost some money, it stinks, but you're smart. Because not only are you watching this video and you're a subscriber to this channel, but also because you're gonna continue to be consistent with your investments. So let's say you invest $10, $20, $100 a week into VTI. You take advantage of buying more at a lower price when it dips. Not only that, your overall average you invested per share goes down when you buy on a schedule. Now that's called dollar cost averaging, and you can learn a little bit more about dollar cost averaging by checking out the video linked up above in the info card. So back to the original question of this video, should you invest in an all-time high? Well, let's take VTI for that example. Right now, it's trading for its all-time high right around $228 per share. Wow, what an increase from that $171 it was in February 2020. If you invest today at $228, will it go down? Probably yes, it will go down in price. Could it go down to $200 a share? Maybe. If you're buying through all the highs and the lows, you're taking advantage of the dollar cost averaging regardless of the all-time high or low, as long as you stick with a consistent plan. Now look at this for a second. Right before the 2009 financial crash, the same type of thing happened. You were up on an all-time high. Everything looked great. And then all hell broke loose and everything went down. But you continued to invest. But look what happens from the period of 2009 all the way to today. All of that time that you've been consistently investing on top of the growth, on top of the dividends, you're growing quite significantly. Remember what I said earlier? From the time frame of 2011 to 2020, we saw an improvement of 13.9% growth. When's the last time your employer gave you a 13% raise? That's kind of the cool part about the market. That's the cool thing about investing. Sure, there's going to be some times, there's going to be some years, there's going to be some months that you may lose money. That's the risk of investing anything in a stock market. But if you stick with it, good things can happen. Now let's talk about how we can turn this stupid into smart in every single way if you're worried about the stock market being at an all-time high. First thing you want to do, I recommend always having an emergency fund first. Have 3 to 6 months of your expenses piled away in a very easy to access account. A nice savings account, that's all you need. Number 2, pay off debt before you invest. Look, if you have a credit card and that credit card is charging you 14 to 22% interest to hold debt, you're actually losing money. Because remember what we talked about, over the last 50 years, the S&P has grown at a rate of 10% on average. Well, that means if you're paying out debt at a 14 to 22% rate, you're actually losing money by holding debt. Pay off your debt, pay off that high interest debt, so that way you have more money to earn more money in the stock market. Then, after you attack number 1 and number 2, number 3 is all about investing consistently. Whatever you can afford. I first recommend starting off with a 401k and make sure you check your job. If your job offers either a 401k or a Roth 401k with a company match, take advantage of that first before you get into any other investing. The reason for that is a match means that this company, your job, wants to give you a raise. They want to give you more money via a 401k plan. And if you're not investing in that up to the maximum amount for a match, you're basically telling your employer, no, boss, I don't need a raise. Go ahead and take your money. We'll just forget about it. That's ultimately what you're doing when you don't invest in a company match retirement account. Then after you max out that 401k match contribution, then you want to look into something like a Roth IRA. I like to max out a Roth IRA every single year because of the fact that even though you're investing in it with money that you have in your bank account, that money over the many years ahead will grow absolutely tax-free. Once you hit the age of 59 and a half or older, you can then take withdrawals from your Roth 401k without paying any taxes in the future. That's the benefit of that particular account. So take advantage of that after you do the 401k match. Then number 3, take advantage of brokerage apps. After you've maxed out all of those different opportunities, then you can go into a brokerage app. I recommend something like Public, for example, public.com, which by the way, they're offering a free share of stock simply for signing up. So make sure you take advantage of that opportunity. The link is in the description below. Get started with your Public account, and then you can invest in fractional shares consistently over time. Maybe you can cut something out of your budget and afford $10 a week into public, invest it into your favorite ETF, invest it into something like VTI if you want to, and then from there you can decide how you want to scale that up as you continue to earn more money. Don't worry about the highs and the lows. It's the same as saying, hey, is it going to rain anytime in the next year? I could almost guarantee it's going to rain in the next year. Almost as much as I can guarantee there's going to be highs and lows in the stock market in the next coming years. It's going to happen. But we're going to continue to build up our mountain because we deserve it. Here's another personal finance video you'll find helpful. Here's something YouTube thinks you're going to like. And until next time, we'll see you on the next video.